Hi, I'm Manish Dhawan with my good friend Puneet Khurana. We run a blog by the name of stoicinvesting.com. This is our podcast series. Life is too short to learn from just your own experiences. To inculcate vicarious learning, we will be interviewing and profiling interesting people from different walks of life. Hopefully, this endeavor will shorten the learning curve for our audience. Ladies and gentlemen, today we have with us Mr. Alok Jain. Those of you who are on Twitter would know that he stormed the Twitterati world with his MI50 momentum trading system with all its backtests, simulations, and projections. From there on, his performance graph did the talking mostly. Now, I know it's too early to pass a judgment on the robustness or efficacy of his system. However, one thing you can be sure of is the amazing transparency and accountability he brings to the table. In the financial world, skin in the game and accountability is a very big deal. And so he had to be part of Stoic Investing podcast. Let's listen in to a fascinating conversation. Ladies and gentlemen, we are here today at Delhi Lawn Tennis Association Club, sipping beer with none other than the momentum master Alok Jain. Hi Alok, welcome to the show.
Hi Manish, glad to be here.
Hi, Alok.
Hi Puneet.
Manish, since momentum is your domain, let's start by you doing the round of introduction.
One thing that I'll definitely like to say is that I'm a big fan of Alok Jain, and the reason is the transparency that he brought into the entire game. We're so used to seeing these analysts who come on TV give their tips every day and then forget about it the next day. There is absolutely no accountability whatsoever. And in comes this gentleman who basically changes the game on its head on his website, a small blog, to be honest. And he basically puts everything right up there for everyone to see, whether up or down. And that kind of transparency is just phenomenal. And I just am a huge fan of Alok for that. So, Alok, let's start from the start. Tell us something about yourself, your background, and what got you interested in the market.
So hi, thanks for the nice intro. I don't know if that's well deserved or not, but essentially I got introduced to the markets quite by accident. I was in the US studying biotechnology in 1991, and my advisor there, he wanted me to go for a Ph.D. And believe it or not, till that time I was not really thinking about where the career would take me. And then I thought, if I go for this Ph.D, I would go into academics most likely, and that is not my preferred domain. So I went to the dean of the business school in the same university. I was at University of Maryland. And I said, sir, I need to do an MBA and a master's in finance dual degree program was there. I said, let me get into this. He said, and I said, I don't have the money as well, so you have to give me the tuition fee.
Okay.
And he said, okay, try to get a GMAT score of so and so, and we'll offer you tuition waiver. So I did about 4 weeks of study, and I was able to get that score. And I hopped into this business school on the same campus from my master's program.
Nice.
And 2.5 years later, as luck would have it, my father called me, and he said, being a small family, he said, either you come back home or you call us to the States. There's no point living separately. And I agreed with that. And at the same point of time, I think it was late in 1993 or early 94, the National Stock Exchange had been formed. And they had invited new professional members for Delhi area. And my father, being an old-time investor, he was very interested that I come back home and I start a business in the family. And by that time had pretty much decided that I want to come back home and I don't want to live the rest of my life in the States. So sometime in 95 I moved back here and I set up we applied and we got through the membership along with some help from family friends. And in 95 we started a journey and set up a stock brokerage house at the NSC. So initially it was designed to be an institutional and corporate broking business, and we set up our office in Delhi and Bombay, and that went on for some time until the business, I think post 97 or 98, started to become very murky, in the sense that no deals were going through, and dealers at various institutions would ask for all kinds of favors if they wanted to place the orders with you. So I was not liking all this from the very start, and I told my there were two sleeping partners in the company, and I told them, I have not come back from the States to do this kind of work, and I want to do a clean, transparent business, whatever small or big that may be. So we gradually, in fact, that was a time when we started making a platform for online broking business, which was sort of not heard of in India so far. India Bulls was creating one, but nobody had launched it, I think, before 99. And just when we got ready to launch it, somewhere in 2000, the market crashed. So that's the initial phase of our business, going from institutional to online attempts, and then ultimately we moved into retail a few years later. Within the broking business, I would say there were moments where the business was really slow. That came in during 2001 to 3. I actually did not know what to do. For 2 years there was no business and absolutely no work. No trading, back market was just flat. If you've not witnessed those 2 years in your life, you haven't seen flat or dead markets yet.
What 2 years were these?
This was 2001 to 2003, just before the bull market. So you can say it was a calm before the storm. It was so dead that I actually started another business alongside. I opened a BPO, a small 20-seater business, which was transcribing financial statements of US companies. So I had a client in the US who would send me overnight, financial earnings calls, and we would transcribe them and give them an overnight turnaround. So the Indian market was so dead at that point of time that I had no idea what to do with it. And then, of course, the boom in 2003-4 started, and business started to come back, and that party lasted till 2008, after which again the same phenomena happened. So to cut the long story short, basically over the years, while I was doing the brokerage business, I was also very keenly developing certain side skills in trading. So I was very fascinated with people like big trading names, maybe like turtle traders, or people who were doing certain things in a more systematic manner. So the system trading, I would say, was getting into my skin for the last decade or decade and a half, but it didn't come up until much later. I would say not even till about 2010. And since 2010, of course, I've been doing a lot of system trading, earlier in the indices, and last couple of years in stocks through this momentum system on my blog, Weekend Investing.
Right. And so did you try other methods of investing or trading before zeroing on momentum?
So I would say I pretty much went through the entire spectrum. In early in early 2003, 4, 5. In fact, from 3 onward till 8, I was doing a lot of what's now being called BTST. And in those days, these terminologies were not coined.
Buy today, sell tomorrow.
Yeah. So essentially, the alpha was getting created in the fact that when the news was getting out, the dissemination of the news was very slow, at least in those days. While you didn't have so many social networks and so many online facilities to disseminate the news. So at NSE or BSC announcement page, if you saw an announcement of a results or a news or a any new discovery, it took a few minutes for it to get discounted in the market. CNBC would take a couple of at least a minute to flash it, and other websites would pick on it a few minutes later. It is almost not like today where algorithms are picking up things, and there's hardly any delay. So those kind of activities were kind of building a sense of momentum in my thought process. Though if I think about it today, those were the years when unconsciously I was getting used to playing momentum. So a news would come out at 11 o'clock, and I would take a position in that stock, and there's an initial phase of that stock going up if it's a positive news, and then the market would react back. Then at the end of the day, there was another move wherein the people who were wanting to take deliveries would get in and were doing BTST. And then there would be another move yet again the next morning after people read the newspaper, etc. So on one single news, you could have played the market almost 3 times. So that inherently was, momentum play, although on a very short time frame. So I used to do, a lot of such type of trades. Then, of course, I did try my hand at investing at various times. My biggest, I think I would say, bad investment, if I can call it. It was not really an investment. I was working for a Hyderabad-based large software company. I won't name it. And I was working with the company as a corporate broker. And the stocks were very illiquid. And they would accumulate stocks through mutual funds because we had empanelment at various institutions. And, I would, it was days of physical share certificates. So I would, scrounge around, get 5,000 shares from here, 10,000 shares from there, from various institutions, make a bunch of 50,000 and go to Hyderabad and, give it to the company and get my money back. This happened for a year or two, and then they defaulted on me. So I had with me, good 50,000 shares, bought at about 50 rupees, stuck with me, and 25 lakh rupees of capital in those days was a good amount. So, I pleaded with the company, and somehow after 3 months of pleading, I was able to get my money out. And that stock, which 25 lakhs were stuck in it, that went from 50 rupees to 7,000 in the next 1.5 years. So although it was not a planned investment, but had it become a incidental investment, that would have given me a lot of confidence.
So you basically forced yourself out of a fortune.
That's true. So if somebody tells me a sob story these days, or I tell them this story, that this is what I missed, and no sob story can be bigger than this. So yeah, but coming back to your question, I did try a hand at investing. I found that it was not my cup of tea. I tried my hand at intraday trading. I tried my hand at BTST trading, and I did a lot of positional swing type of trading. And reasonable success I got in it. I remember, at least during the bull years, returns of 50 to 100% a year was not out of the normal. So that kind of returns were possible. Of course, the scalability of that model was a question, because without a system, without risk management on each trade, I mean, you couldn't really scale it up. I mean, could you go from, say, risking 1 crore of rupees to 5 crores to 10 crores? Could you do that? And one was that the opportunities of liquidity of that kind of scale would get limited. And two, your own sense, because you were not having, at least I was not having in those days, any reasonable risk management in my trades. It was a lot of, just go with the flow kind of a thing.
So would it be fair to say that prompted you to move towards automation?
Not that type of trading, but I think 2008 definitely did. I think in 2008 I was heavily leveraged. 2006, 7, 8 were good years. I was heavily leveraged. And post 2008 crash, like most people, I lost a ton of money as well. And I think that was the time what got me thinking that, although what I'm doing is definitely right, but not in a proper risk managed way.
Okay, so the shock of the 2008 basically prompted you to devise automated system.
Yeah, so that event made me start thinking about system driven trading, maybe not automation, but system driven trading. And I think I read a book by Van Tharp or some articles by Van Tharp, and that got me thinking about position sizing. And I initially started trading on the index. So from 2008 till 2013 or so, for 5 or 6 years, I was just trading Bank Nifty and Nifty. Okay. And a momentum strategy, both long and short, I was trading on this with position managed and money management in place, and we are getting a reasonable ballpark 20% a year on a low leverage. So that was reasonable going. And I introduced my clients, the broking clients that I had. We had a good number of HNI clients in the broking company, and they were always looking for additional sort of returns. So I introduced this system which I was doing for myself to them, and for a good 3-4 years we did this as a managed portfolio.
Okay.
The trouble that we saw was happening was with the business transaction treatment of derivatives trading. So just imagine if some client had, say, 5 crores and you were doing a leveraged Nifty trade on that, and say you did a one turn of Nifty every week, and say a leverage of 2 times. So that would translate into a turnover of about 80 crores per year, per month for that client.
Right.
And that translated into, when the income tax was scrutinizing his books, that came out to about 1,000 crores a year. And if he was showing, profits of 20% on base capital of maybe about 1 crore of rupees, it was difficult to justify to the income tax.
Tell me about it.
And so many clients were starting to complain about the treatment that they were getting from the income tax on this, and also that this was not really tax efficient. So 30% of tax, 30 plus percent of tax on 20%, and then if you had to sort of part with some profit sharing, I mean, that really reduced the returns for them. That point was really when I started to think about, why not go for distributed or diversified stock investing with momentum, of course, in play, and do only long only play. And the system is tax efficient, and most clients are somehow more comfortable investing in stocks than dealing with even low leverage derivatives.
So Alok, let me ask this question. I mean, from the journey you have told me so far, and that went from mid 90s to 2008, And so far, and I forgive me if I'm getting something wrong here, but so far what I'm getting is that majority of your source of income was your business and your brokerage and the business which you did with the Hyderabad company. But was it investing? Was a sizable chunk of your money coming from your trading activities, or was a sizable chunk coming from your business activities?
I think the business activities were definitely the bigger pie, and trading was very, very small compared to that. And because it was not the major focus that I had, I was running the business along with the other investors in the company. So trading was a passion that was developing over time. So I wouldn't say that scale of trading was reasonably high.
So would it be fair to say that 2008 hit was only on your trading portfolio and not on the business portfolio, besides that money which gets stuck with the client?
Yeah. I mean, 2008 hit that I was mentioned was on the trading portfolio, which was more individual than business in nature. And of course, the business got hit because of the general market sentiment.
So why I'm asking this is because people try to leave their jobs and start without having any savings to speak of, and then they try to leave their jobs and they jump into trading. Especially this is the scenario in last 2-3 years we are seeing when the bull market is going. So I just want to put across this point that most of the people, they ignore the initial capital component when they are doing their $1 million calculations in their dreams.
And I think in a bull market it's easier to do those calculations and extrapolate on your Excel sheet. This is where I'll be in 5 years or 3 years. But I've seen in my own experience that after the 2000, the Y2K, the technology boom, there were a few clients who came into a brokerage house who were with good jobs, and they had left their jobs because that boom gave them a reasonable confidence that they can sustainably manage on trading. And in just a few years time, I found that they went back to their jobs. They could not sustain it. So definitely, unless you have a reasonable financial independence that you can claim, I don't think you should be leaving your jobs and jumping into trading.
Can you quantify it? Let's just say somebody is interested in making this investing or trading as a career. What do you think is the minimum benchmark money that he should have?
Yeah, so I've always said this, and you may have read it on Twitter, that I think that you should do it on the side and only jump in full time when your investing / trading returns have exceeded your daytime job returns. So if that equation is happening, then I think it is reasonable time or reasonable risk-taking time to jump into full-time trading.
I'm pretty sure this would disqualify 99% of them.
Okay, so if I do a rough, back of the hand calculation, if a person has an income of around, let's say, 10 lakhs a year, just for the sake of calculations, and approximately his expenses are 30 to 40% of that, so let's say around 4 lakhs. And now to make 10 lakhs from his portfolio, he would have to have around 50 lakhs rupees, at least, assuming that he can do a linear of 20-25%, so let's say 20%. And if he intends to compound it, he also need to have a source of income to support his expenses. Otherwise, he will end up eating the profits and reducing the capital for future compounding. Or maybe you can just incorporate your expenses and add more to the capital number accordingly. So what I'm trying to say is that if you have to think about it, you have to be in a position to comfortably sustain yourself. But this plain, simple mathematics takes a backseat when people are thinking about this. And to go and jump into full-time investing without having enough buffer is an extremely risky strategy.
Although I would say that 20% is not a big deal in trading. I mean, if somebody is really picking on good trading skills, they could go much, much higher than that.
And you are saying it post-tax and post-transaction costs?
Yeah. So like I was saying, between the years 2003 to 2008, maybe I was compounding at between 50 to 100% every year.
Having said that, you also probably have to account for drawdowns and bad years.
Yeah, so 2008 probably washed off 20-25% of that. But still, I would say the returns per year would have been much in excess of 20%.
This whole period was that momentum trading you were talking about?
Yeah, so basically it was mix of either positional or doing or demerger plays. I did a lot of demerger plays also during 2003-8.
Can you throw some light on that also? What demerger plays?
So basically, we're basically trying to capture the sum of parts and value unlocking that is happening during the demerger. And a lot of times I've seen that during bull markets, a lot of corporates either use this vehicle to get higher market capitalization. And during 2003 to 2008, I would say every other month there was one big corporate restructuring that was happening. So Reliance went through it. I think there were several others. I'm not remembering right now. Several others were there, and I got stuck in one of them, and that really put the lights on for me in terms of diversification in portfolio. So there was this company, still exists. They were diversifying, demerging their telecom license into another company.
Okay.
And this was, I think, 2007. And they got a telecom license through the new license allocations. And Russian company came in as partners for them. And I invested big time into this. And what happened after that was that the company which had the license never got listed.
Okay.
So once the main company got listed and that part was sold off, the second part was never listed, and the company kept what should I say, dilly-dallying the decision to list under some pretext or the other. And there were 18,000 minority shareholders of that company. They were stuck. So we went to SEBI. I went to Jaipur High Court. I spent, I would say, at least 100 trips to Jaipur High Court on this over the next 7 years. And I really went all out, to get justice for myself as well as for other minority shareholders.
I'm just curious, what percentage of your corpus was invested in this for you to take out this kind of effort?
Maybe a third of my trading capital.
Wow.
So that was a large chunk, and although they were, they sold a significant chunk to the Russian company at 5 times par, but they were not willing to share any returns with the minority shareholders. So pure case of mismanagement of minority shareholders, but we fought for 7 years and we still lost it because we could not field the kind of counsel strength that they could. Right. We had the best of lawyers of our capacity, but we could not match them. So that kind of drill down the concept of must keep your eggs diversified.
Especially in in the environment we operate in, because one of the big reasons why we don't have any kind of shareholder activism in our country is primarily because what exactly you told right now.
Yeah, that was a harrowing time. If you imagine going to a court 100 times, it is actually a very negative environment. It accepts you out.
And this particular case is not involving family issues and the promoter threats, which is also a very common thing. Which
we were told that don't go for it. The Russian mafia will be after you and so on. but me and another one of the other large investors, we did try our best, but somehow it didn't work out. So yeah, it was a good lesson learned.
Well, it's a very valuable lesson for all of us who basically load up big on demergers, because this is pretty eye-popping. One of those demerged entities might never get listed.
So when you were into demerger plays, I want to understand, in the trading side, when you're taking this kind of a bet, which was 1/3 of your portfolio, what was your risk management at that point in time for these kind of companies? Was it a price-driven stop loss kind of risk management?
I would say there was hardly any risk management.
Okay.
Because one, risk management would come after you get a lesson from the market, and till then there was no lesson virtually, and it was a bull market, everything was going up every day, so you didn't really care at that point of time. So the lesson learned later was, of course, to bet only a reasonable size in. And also, while demergers are happening, one should definitely look at the quality of the company, regardless of what value unlocking may be happening. Because the quality of the promoter, whether they will, mismanage the minority investors, that is very, very key. Just imagine losing a huge chunk of your capital just because the company didn't list or the promoter, did something.
That part which you are saying is extremely difficult to, boil down to, because there have been couple of cases where even very good quality promoters have gone down to take very anti-minority shareholder. And I'm talking about MNC companies and,
That's true, but there's a large section of people in the market, there's a large section of investors in the market who go after every demerger, almost assuming that every demerger will result in value unlocking.
Right.
So Manish can probably tell us the last few demergers what has happened. I haven't been following.
No, so they all have been profitable. Majority of them, yeah, irrespective of the quality. Yeah, I think we're entering this. We are entering the same field again. No, I don't participate in all the demergers, but yes, we are entering that field where people starting to getting the feeling that demerger is equal to value unlocking, irrespective.
So what needs to be seen is what is the run up before the demerger. I mean, a lot of times, the date of the demerger, if you see, the stock has run up 50 or 100% already. So a lot. I think over the last 22 years that I've been in the market, I can say with reasonable confidence that our market is, if not rigged, is definitely very, very influenced by insiders. And value investing, can work only to a limited extent. I cannot really paint a brush across, but momentum investing came more into focus because I realized that even if things are rigged or not clean, you cannot cheat the momentum.
You cannot cheat the price. Yeah,
you cannot cheat the price. So price remains the one commodity that you cannot really cheat.
Okay, so again, so let me be the devil's advocate, because both of you are momentum people and I am completely out of it. So on the contrary, isn't it the only thing that can be completely manipulated when it comes to when I'm talking about price now?
So let me tell you a interesting story. That in 2016-17, in one of these strategies, MI50 that I run, one of the largest gainers was a stock called, which people say is a totally manipulated stock. I don't know, but that's what people say. And we got the largest gain, or one of the largest gains in the year, in that stock. So yeah, it ran from 20 rupees to 220. We caught in at around 65. We got out at about 165. Purely on a price basis, I don't give a damn what the quality of stock is.
No, fair enough, but that doesn't answer Puneet's question. And one-off example probably doesn't change anything, right? Because there's survivorship bias that comes into it. The point that Puneet was making is that momentum, price is the only thing that we are concerned about, and isn't that the easiest thing to manipulate?
So, okay, let me give you an example so that it makes a bit more clear. So majority of the time, and one thing which has happened to one of my holdings extremely recently, and I don't want to name it because of some regulatory issues, but it was fairly obvious that majority of the price which got out, I mean the increase in the price was completely driven by very heavy buying on absolutely no fundamental reason whatsoever. There was nothing. I've been tracking that company pretty well, and by the time it reaches a price where the momentum people generally jump in, and it's after a significant move with a significant volume, it was a dumb situation, and that is very often done by many people when they rig up the price and then they just dump it up.
That's possible. Probably that happened in one of the recent cases.
So I think the question is, what is the success ratio of number of picks you generally do via this momentum strategy, and when it fails, how much is the quantum of failure you take, which is nothing but the risk management strategy, I guess.
Basically, you will experience a few such cases every year, I would say.
Yep.
Especially in a bull market scenario. And sort of you are accepting this as a business cost, that a couple of your positions will go awry.
Right.
And if you're running a 25, 40, 50 stocks portfolio, a 2% or a 4%, even if the stock goes to zero, which is usually not the case, if you take a 20, 30, 40% hit on one of your components, which is like 2% of your portfolio, I still think it is worth going after price and absorbing these one or two shocks.
Yeah, in fact, if you run a back test on any momentum strategy, you're absolutely spot on that every year you'll come across a couple of them, if not more. And point is, your CAGR returns that would show take into account these shocks, because you're anyways not betting more than 4-5% per script.
So the concentration of your portfolio is actually key. I mean, if you are running a 5 stock or a 10 stock portfolio, and you get 2 such stocks, that can significantly jar your CAGR.
So would it be fair to say that momentum should be practiced on a diversified portfolio only? Or let's say if you have to practice it on a concentrated portfolio, which I think Manish does, your strategy has to be extremely different.
I think if you're running on a concentrated portfolio, then definitely yes, you'll have to have quality filters in check.
And when you say quality filter on what basis are you talking about? Are you talking about fundamentally, or are you talking about?
It will have to be fundamentals, and that will defeat the purpose.
The purpose of doing momentum at the first place. Because
Back to square one.
So effectively, I should take the message that if you are doing momentum, you should be diversified, because you are effectively betting on
the price. Yeah. I think that is.
You're basically you're basically betting on price, and you're saying anything which is moving, I am willing to take a look at that.
Right.
Versus if anything is moving and the fundamentals don't support it, and you say that maybe the price is getting rigged or some.
That brings me to my next question, and it's actually a related one. Have you ever thought of mixing the two, technicals, the momentum and the fundamentals?
Yes, that is actually a project or a dream in progress, wherein I want to have both portfolios, and when the momentum works, I mean the value has no clue what's happening, and on the other side, when the market is.
No, so Wesley Grace talks about the same thing. He has 2 different portfolios, one for momentum and one for value. And he's of the opinion that they complement each other, like you said. But my question was, have you thought of mixing the two?
Probably I ran some tests in early years, but that defeats the purpose of that particular silo. So if you keep them in different silos, they will take care of different market situations.
Manish, if you will remember, we had the same discussion with Wesley Gray, who does the same thing, and he, in all his backtests, he told that if you want to mix, you have to mix it as a part of your total portfolio. You have to have portion to value and portion to momentum, but you can't really apply momentum on value stocks or something like that. I think it defeats the purpose completely.
My point is, that is too academic, and he misses on what has been picked up by people like William O'Neill, Mark Minervi.
And I disagree that they do a good quality fundamental check before they.
Yeah, I'm not talking about in-depth fundamental analysis. They're basically, at least they're taking care of the earnings, right? And the basic balance sheet.
No, but that again would defeat the purpose. You're looking, in the rear view mirror when you're looking at earnings and balance sheet. I mean, momentum is basically looking ahead. You are looking into the unknown.
No, but the names that I mentioned who mix these two have records which are stellar par excellence.
Okay, so yeah, I haven't really done in-depth work on this, but yeah, that. But I definitely believe that if you keep the two in different silos, they will serve good complementary purposes to your portfolio.
Right, great. So Alok, tell us, tell the audience something about, in fact, everything about the two systems that you're running, MI25 and MI50.
So essentially, without going into very specifics of it, the whole idea is to catch the momentum young, keep a lookout for fading or wavering momentum, if I may say so. Discard the weaker stocks in the process, and hold cash in debt whenever momentum is not available. So this is like the 3 steps on a macro basis that I take. So if I don't find enough opportunity, I stay in debt. If I am finding opportunity, I would go diversified into these 30 or 40 or 50 stocks, and it is basically almost a process of like natural selection. So the fitter ones stay, the non-fitter ones keep getting filtered out.
So when you say it's a system where it tells you how much to get in, when to get in, when to not get in, are you referring to any trend following overlay on the broader indices?
No, I don't do a trend following overlay on the broader indices, because what I've seen is that if you do a trend following overlay on broader indices, you might be delaying the start of your entry into the momentum stocks, because the broader indices are usually lagging, and you might miss out on the initial leg of the momentum. So the idea is that, like for instance, let's take 2008. Now in back tests, the system went fully into cash by mid of 2008, and then for the next 6 or 7 months it did not pick up anything. So it stayed in cash for about 6-7 months. Now when 2009 recovery has started, you will find that green shoots will start to appear. So every month there will be 1 or 2. You want a bunch of 50, but you're getting 1 or 2, and those are the initial sort of momentum stocks that are jumping up. And if you were to sort of put a overall filter on the market trend, you would get nothing till maybe October 2009. Like the market will take its time. By whichever way you will measure the market trend, even if it's a simple moving average, you would have lost a significant part of those green shoots that would have come. And beyond the momentum part of it, it will give you a very clear indication which sectors of the economy have started moving up. So I am seeing outside this model of momentum, it does give you a lot of information about sectoral changes.
Right.
Like suddenly, auto component companies would come into play, or suddenly, the others have gone out of flavor.
Very interesting, because I've actually seen the practice of it while following the MI50 model. Your system picked up all the sugar stocks right at the right time.
Right. So there were 2 legs to sugar, and we got in the first leg, but the second leg we missed out. And these are the inherent sort of shortcomings of the system, wherein if you are fully invested and there are signals, you have to just let them go by.
But that's probably because like you mentioned, part of your system is to look for early momentum, and so the late momentum would obviously be missed.
That's right. So we did get a good chunk in sugar, and recently, in fact, this last Friday, while the market was coming down, we've lost a lot of auto ancillary. So I'm actually going to look out for other signals that this industry's momentum is going away. Jai Bharat Maruti got out, Bharat Gears got out, and I think there was one more name.
So just to sum up this part of the discussion so far, where your entry is based on momentum, can you give a closure to this topic by defining your parameters for momentum? I understand that price momentum is what you are seeking, but are you looking or combining other data points like volume or any specific indicators which are mostly used, or you want to throw light on, or is there a filter on what kind of companies you want to look at? And it could be anything. It could be liquidity or say anything, or any of the things that I mentioned. Any of those come into picture or not? And so what I'm trying to do is provide a closure to the discussion so far, what we have done.
And before you answer that, Alok, I have a related question. You can club both of them together. Do you sometimes feel like a torchbearer who's legalizing marijuana? Because momentum investing, if you ask any value investor, is actually an oxymoron. There is no momentum investing. Momentum is always trading. So, club these two questions and give the answer.
Yeah, so for me, I mean, there's a Gujarati saying, "Bhao Bhagwan che." So price is God, and price is this the supreme commodity that we are looking at. So everything is around the price. Of course, there are all kinds of filters around it that will remove the chaff and the stocks that you don't want to get into, because you also have to see what scale you're going to operate at. Say you want to run 5 crores in momentum, you could look at a stock which at a 2% basis you will be maybe investing 10 lakhs in it. So you could look at anything which trades maybe 2 crores or 5 crores a day in terms of price times volume. But if you want to scale up and go further, then a lot of the market actually goes out of the picture. So that part actually is a very disabling part of our market, because the depth exists only in so many few hundred.
Which, by the way, most of the backtest will miss out.
The backtest was also miss out on lower volumes or those kind of things. So coming to Manish's point about being a torchbearer, I don't think so. But
on the contrary, the moment you mentioned torchbearer, I was having a question in my mind which was completely opposite, which was that momentum in itself is probably as old as the markets are in terms of strategy. I mean, think about all the books that have been written and all the traders you have heard about. Since momentum is, and Eugene Fama has himself, accepted the fact that if there are two anomalies to the efficient market, that one is value and one is momentum, and momentum is well researched. There are hundreds of books, and there's a turtle trader, and there's no dearth of the research on momentum, and there's no dearth of practitioners of momentum also. I mean, let me put it this way. So where does the edge for a momentum investor comes from? I can talk from the fundamental investing where the edge comes from, but in the momentum, what is the edge? Because at the end of the day, the price signal is not that difficult to read compared to a business fundamental. So you might, because of the nature of the thing, you might expect many more people to be able to do this. Where does the edge come from? And being so much of research available, what exactly is what differentiates a good momentum person to a bad one?
I think that's $1 million question, and so far I don't think anybody has been able to answer it. It is a function of human behavior, and people have tried to put their finger on it, but nobody knows why or how momentum exists. I really don't think so. I've read many papers on this.
No. The question is different. The question is the people who are successfully practicing momentum trading or investing vis-a-vis the people who attempt the same thing. What I'm trying to understand is that the parameters are not so many parameters. It's just price and volume at the end of the day.
I think at the end of the day, I believe any system is only 20% of the game.
Okay, and what is the remaining 80%?
80% is discipline and staying the course.
So are you saying that most of the people who follow momentum, they fail because they're not able to stick to the system?
Maybe they've not got the system right, but a lot of people will fall off because of the discipline part.
I think I can say the same statement for value investing as well. 80% of value investors fail because they're not disciplined enough to do that.
Yeah, Manish, and that will be true for almost every profession, not only investing. So there will be few outliers, and they will have the mix of all the right things in place: intelligence, right method, discipline, all the behavioral traits you need to have, and so on and so forth. So I understand that right method is only a part of the answer, but the point here is that it's a very crucial part. I mean, if you're disciplined and you have a wrong system, that is more dangerous than a wrong system and being undisciplined. Might be undisciplined will be helpful in that case. So a right system is paramount, obviously. And what I'm trying to gauge here is that whether the reason for failure is mostly a wrong system, or is it bad discipline on the part of people who are not able to do well in momentum strategies per se.
I think that part of your question remains unexplained. I mean, momentum remains an anomaly.
Yeah. I mean, I don't have any answer to that. This guy Gary Antonacci's website does say a couple of things about why momentum works, but I mean, all that's theory. Obviously, he talks about the behavioral biases which results in what goes up keeps going up.
That's the answer to everything. Why everything works is because of human behavior at the end of the day. Because majority has to be wrong for it to work.
No, but the closest answer I would imagine is this human behavior, inertia of inertia of the play happening, and more people running after it.
So somebody said this, I don't know the source. I think Wesley Gray's website mentions this. Value investing is overreaction to a bad news, and momentum investing is underreaction to a good news.
I'm not so sure, but
Me neither.
I mean,
I'm just
Yeah,
quoting
yeah.
him.
I would say momentum in most cases would be front running a good news that is about to come. So whether it is going to be good news or what kind of news, but you are in the realm of the unknown, and at that point of time, value in investing is not able to explain the current situation.
Yeah, so who is the first leg who is buying, which is leading to that momentum at the first place? I think we should spend some more time on the system, not getting into the specifics, but the nature of the system per se. So we have discussed about the first part of it, which is getting into the momentum. The second part of your system, which you said, is about getting rid of weak momentum or low quality momentum, if I can call it. What are the parameters of the thought process which you have in determining that part? Is it, again, purely price driven lagging which is happening in the momentum, pace of momentum? Like again, coming back to Wesley's work, he talks about quality momentum, where he is filtering out a large amount of momentum, which is very short-term momentum, so to speak. So what is the thought process when it comes to quality of momentum which you're talking about?
Overall, I believe that the entire game is hinged upon this issue of exit. I think a large part of the trading game is done successfully or unsuccessfully based on the exit. Entry everybody is able to do, either sooner or later.
All the pharma investors would agree with you.
So exit is that enigma that you need to unlock, and I believe exiting is possible only in two ways. Either before you enter a trade you know where you're going to exit, either that, or it's a constantly re-evaluated and recalculated parameter.
Which is what a trading stop loss is. See, you have to believe that I'm not at all into momentum, so please forgive me with this. But what is the difference between what you're saying?
So trading stop loss, yes, it is an exit decision, but is it a calculatable and in a scientific way of calculating at every moment, on every day, for instance, or are you actually putting it into the system, or are you actually going to create certain amount of discretionary power around it? So many things are there. Very simple, you get into a stock at 100 rupees, it has gone to 120, today is a good day, it is going to 130. What happens if it starts dropping today? Where will you exit? Is that defined to the core or not?
Let's say you have a moving average based system and you say, okay, I will follow this moving average line. So are you saying that, okay, that decision that, okay, this, if it goes below MA, whatever, I will make an exit no matter what. Is that what you're saying?
No. So moving average is very, would be very elementary.
No, not moving average. I'm saying just like moving average, some parameter which is calculated number.
So some parameter which is calculatable and which is absolutely crystal clear in terms of, execution capability. In terms of if this parameter is getting violated today, then I'm getting out. If that is defined, then you got a good exit. If your parameter is that at the end of the day, I will reevaluate the entire situation and tomorrow I will think, for instance, where I may exit. Or, in a way, you are not looking for an exit, sort of. What I'm trying to say is, when you are into the position and it's all is going well, you are not, your system or you are not thinking or looking for the exit. I am saying you should at all times be thinking or having an exit.
So your exit strategy is completely coded? Okay, so you don't have no discretion whatsoever. And you check those exits at the end of the week. That's what your weekend investing is all about. So within week, whatever gets exited, you don't see. Is that what you're saying?
And a related question to that, Alok, and you can decide to say no if it's too intriguing. Does it change? Does your stops change based on the performance of your particular stock?
I didn't understand the question myself.
Okay, so let's just say I have a 10% stop, hypothetically. If the stock goes below 10%, my purchase price, I'll exit.
Okay, so that will be like a fixed stop loss system.
Just a hypothetical example, just be with me. And now, let's say 3 months later, the stock is at 100% gain. And now my stop loss is a lot different than what I initially decided.
Sure. So, I do trail.
Okay, let me rephrase it once again. So let's just say I had a trailing stop loss to begin with. But now that my stock is successful, I will...
Or you're saying the whether the stock loosen or
tighten or whatever.
Yeah.
Change the...
No, I would not change the dynamics of it. I would keep it as loose as it was. Yeah. What will happen, however, is that suppose your stock has gone up 100% and then it starts to consolidate. Then due to the time value or due to the your trailing part, it may get a little closer to your price. So it may tighten on its own, for that matter, just like an ATR for that matter.
Okay, I'm still not clear on the volume answer. You said that you use volume as a parameter, not for filtering, but even for entering positions, or it's purely price driven? Okay. So on the quality side, you said that you don't really have a parameter in terms of judging the quality of the momentum. So what was that your second point all about? What do you mean by when the momentum starts to fade away? Are you talking, because a fading momentum, in my basic understanding, will not really be hitting your stop losses.
It is essentially a sort of a rate of change, a relative rate of change, you can say.
So the point is that and let me just again ask you very broadly, do you do all your calculations on a weekly chart basis, or what is it?
I do on a weekly, and I also have a monthly product, so I do a monthly as well. So that is not in public domain. Yeah. So I, recently I had announced that I will launch it this month.
And what's the difference between the two?
So essentially, the difference is a different methodology of entry and exit. The basis remains the same. I mean, you're looking at momentum at large, but the different parameters used to entry or exit, these various strategies could complement each other. So the idea is to distribute your money amongst various strategies using the same stocks, using similar momentum strategies, but with different entries and exits, which will smoothen out your returns curve actually.
So Alok, this is a different strategy that now you're talking about. Now, I know through our conversations that you're not much into books. My question is, how are these strategies coming to you?
So I do a lot of chart reading. So I look at a lot of charts, and as you may have seen, I tweet a lot about various trades based on chart readings. So I eyeball a lot of charts and I try to find what are some obvious or recurring patterns that I see, and then I try to code them or try different ideas on them. Remember, I'm free for 6 days of the week, so so I need to fill those hours.
By the way, just out of curiosity, do you code or do you have a team which codes? Or
No, I code myself.
you code yourself. So you are very well versed with the coding.
I am not well versed, but whatever little I know, I do.
Okay. And in what tool you use for the coding?
I use Amy Broker.
Okay, so just like yours.
And then you try to code them.
In fact, I attended one of workshops like you did recently, I think. I think this was 2013. And that's where I was really able to put my ideas into a sort of a real test. Before that, I had no clue how to.
Okay, so let's say you evaluated something from the charts and you're able to judge a pattern, which is exactly what you're looking for, and you go about coding it. Is your test of strength of that idea based on backtesting, or is it as in when I'll keep on testing, I'll see whether it works or not?
So I try to do as much as rigorous testing as possible. I try to run it live if it's a smaller time frame. Like if I'm doing it on a monthly, it becomes very difficult for live testing. So on a weekly, before I launched the public MI50, I probably ran it on my own money for about 6 to 8 months, and then I launched the public.
So Alok, it's one thing to have a system, and totally another to follow it. So do you indulge in any kind of mind training, meditation or anything?
I would love to. I haven't gotten around to it, but I would, if I were to evaluate myself, and probably I'll be biased in that, I would say that I am quite at peace. So from that point of view, I can really, withstand good drawdowns. Also because I have tested and ran money on these systems for some time, and I think the entire market whipsaws are a result of people who are either getting greedy or fearful, or as the conventional 4 animals of the market.
So in 2008, what would have been the drawdown of your MI25 and 50?
It would be close to about 30%.
So you were having MI2550 at that point in time? No.
No. If you
You
backtest.
backtest. Oh,
It's a
okay.
backtest.
Sorry.
So, and you're saying that you're stoic enough to take 30% drawdown in your stride.
Yeah, I think 30 to 40% is still bearable.
And the famous saying is, whatever your drawdown is, you multiply that with at least 2 or 1.5. That is the actual drawdown you might get. Would
Yeah.
you be comfortable with a 50,
Yeah, so-
60% drawdown, Alok?
So 30 into 1.5 is 45. So I would say it's still below 50, and one can probably still hang around. But that is a test that one has to go through.
Okay, before I get into the philosophical aspect of it, which we generally end it up with, I have a couple more questions, and you can tell me whatever you want to, because I won't be able to implement it anyways. So again, I got the first 2 part now, which is finding the momentum and then getting out of the momentum if it's weak. Then the third question obviously is the risk management side, and which I am getting a feel that it is trailing stop loss of some form. It might not be a very obvious one like an MA, but it is of some form like an ATR, modified ATR, whatever it could be. I don't know. Is there anything else which is a very critical element as per you? And I'm talking about the thought process, not the exact implementation. But is there any other critical aspect? Because it seems to me that it is too simplistic, and which I can believe that simple is usually beautiful. I believe that statement. But is there something which is a bit more critical aspect, which you probably would want to throw some light on?
Yeah, I don't think there's any very complicated algorithm that is running there. They're very simple parameters that I'm using, and you're basically capturing the market moves using very simple parameters.
If I'm getting the allocation right, I'm just summing up a large chunk of what I've heard. You are not having any kind of system on the broad indices. There is nothing on the broad indices. So whatever it is on the basis of individual stocks. So if something comes up in your system, you buy 2% of it, if I'm not wrong.
Yeah, so one of my systems allocates 2%, another one is allocating about 4%.
And if 2%, so MI25 will be allocating 4% and 50 will be having 2%. Fair enough. So let's say that MI25 allocates 4%. If the 4% capital is not there, it will let go that particular.
It will let go of the opportunity.
If there is less money deployed, the remaining will head into liquid funds. Okay. And again, everything you have automated completely. So the liquid fund automatically goes away.
Yeah, so the trade will happen. Yeah.
When you are away from the system, you're not really watching it. What are the black swan that can come into this whole picture? One which I can instantly think, and again, I'm not a practitioner of your art, so I would not really comment too much, but one I can instantly think is when you put your stops, you must be putting limit orders, or what kind of an order you put, because the stops vis-a-vis the actual hits and a very sharp fall can be very drastic difference between.
Yeah, so basically I use an algorithm to get in and get out of stocks. So it's a order management system wherein a algorithm runs to gradually get in and gradually get out of a stock.
It's not an instant order of all the sale. It is on the basis of how much it is following. So if a first order vis-a-vis your last order will have a price difference of.
Slightly, yes. It could have. I mean, it all depends upon the market. If suppose I'm buying something and there's a big seller in front of me, then even my 5 orders will get hit at the same price. So the black swan could be, a market disruption on the second half of the week, on the second half of the day, on the Friday, and you're not able to close the positions, or you're not able to enter new positions on that day. So that kind of a market disruption event, if it happens, then you will have to delay it to the next morning.
Or a situation where the exit is not possible at all. Shilpi, for example.
Yeah, Shilpi, that case I remember, I could not get an exit for many days, and every day you had to. So yeah, I mean we lost about 30% on that trade, 35%, and those, I guess those will happen once in a while.
Yep. So, are you a disciplined person in real life? What's your daily routine like?
Tough for me to judge, but my daily routine is actually going through a reboot right now. So we are now witnessing an empty nest at our house. We just left our daughter for our university education in Singapore, and so last couple of years a lot of routine has been revolving around her, and her going to college, and so otherwise my routine is reasonably boring and scheduled daily. So I try to wake up early, and I try to go for a walk or a jog, and then I run my operation from home. So I have a small room which I call my office, and so I try to be there by the time market opens, and half an hour just take a look at what's happening. over the years, I've gradually reduced a lot of trading activity. I mean, I used to be a big trader even as early as 5-6 years back. But gradually, what I've done consciously is to reduce my trading efforts and run discretionary portfolio more in terms of positional system and a momentum system. So when you're not really trading during the day, I mean, there's not much to do in the market. So you can utilize that time for doing testing or trying to find some new edge somewhere and developing basically a finer sense of any new system.
Okay, so I asked you about what can hit your system, which is the black swan point. But another thing which I wanted to ask is, since you have first of all done a bit of live testing, and by any stretch of imagination, we should not be judging a system on a small time frame basis.
Sure. It's too early. Even right now, I feel it is too early because I've been running this system for a year and a half live and about 6 months before, so about just under 2 years.
And obviously, the test of the system is on a longer time frame basis.
Full economic cycle is.
But generally, I mean, that's too long a time period for you to judge. But my point here is, how do you, when you're sitting and developing that system on a intellectual, honest basis, what kind of steps you can take to make your system more robust by testing it on the back front? And if you have done that, what kind of market will have the most adverse effect? And I'm not talking about black swan only. In terms of lower return periods, what kind of market is where you're going to struggle? I have an intuitive answer about this, but I want to know from the horse's mouth.
Yeah. So what the way I do it is that I try to increase or amplify the costs that are associated with the back test, which could be slippages, which could be your transaction costs, and you could actually do a better test of your system in really dull periods of the market. So if I believe that if your system can sustain a period of say January 2008 to June 2013, I mean, this period was largely, I would say, first it was humongously trending for first 2 years, and then it went just non-trending for the next 2 or 3 years. So in these 5 years, you got mostly a flavor of all types of markets. Very dull market, sideways market, very trending upwards, trending downwards. You got a flavor of most of the types of markets that you would normally see.
And what about the period from 2009 to 12?
So 8 to 13 would do that. Yeah. So 8 to 13 would include that. And if during that period, if your system is able to give you even reasonable nominal returns, I think it is worthwhile to go.
And what does your back test gives you in those period?
I think we would have got somewhere close to between 12 to 14%.
And this is post-tax, post-transaction cost.
This is pre-tax. This pre-tax and but post-transaction costs. Yes.
The whole idea of momentum, correct me if I'm wrong, is to not get out in those periods, as in don't get bankrupt, and then milk it in the Modi rally kind of situation.
Which, by the way, I think again that value momentum compensation which you're talking about. So I can again give you my personal experience that 10 to 13 was a very, very high return period for me personally. And it was upward of 30% on a yearly basis, because that's a stock picking. It's a stock
second half of 2013 specifically.
No, I'm
right?
saying from 10 to 13.
10 to 13, okay.
So that dull period was a very high return period for me particularly. But the moment you go into the market which is going crazily above, that is a time when you guys will come up and take those returns and mop it up, whereas we get into cautious mode and
Yeah, but cautious mode. But how many value investors actually get out when
I mean, let's separate the bad practicing of an art with the art per se. Okay, so I mean,
No. I really admire the real value guys, because I mean that is something which I think momentum cannot achieve. The kind of returns that real value investors are able to get, I think momentum is very difficult to achieve, because I have not seen any documentary evidence of anybody achieving 30, 40, 50% CAGR in momentum.
No, what? Mark Minervi, Jesse Stein, sure, their number of years is less, but who needs those many years? 1 decade is enough to get financially independent, man. No, my point is, I agree with you that when it comes to the size, momentum will fall flat on its face. But my point is, for us, that kind of size, we haven't reached there, so why talk about it? So, Alok, tell me, when do you know that your system is not working anymore?
So, a few years of underperforming the benchmarks, when the benchmarks are trending, that probably would be the signal that the system is losing, or even the slippages that may start to occur when I'm entering or exiting the situation. That may give me a signal that the efficacy of this system is going away. But to be honest, I don't have a clear answer to that.
But the drawdown would not be a deterrent if it's a lot more than your back test.
The drawdown, if it is much more than what we anticipate, like you said, it could be 2 times. I mean that would definitely make me at least start to think if the market that exists at that time is very different from what earlier drawdowns that we saw. I mean, so if the market went into a lower circuit spiral for like 3 days, every stock would be like almost 60% down. So that kind of a black swan, if it comes, basically, I would say that the system is not foolproof. No system is, I guess. But 2008, I believe, is a reasonably good test of a rigorous downside. I mean, if you've withstood 2008 with a 30% drawdown, it reasonably has tested your limits of the system. And especially because your system stayed out for 6 months. So had it been staying invested and still losing money while the market was going down, then you could say that maybe if the market had gone deeper, your drawdown would have been deeper. But since the drawdown was capped and you got out of the market overall, so in a way you have tested the depths to some extent as to where the system can go.
I think one question I forgot to ask. Is there any other thing you follow besides MI25 and MI50?
I have another monthly system. Yeah.
Monthly, which you are practicing, trying out right now. So, just out of curiosity, what amount of portion of your net worth are you testing up with these systems? I mean, the reason why I'm asking is because that at the end of the day, the conviction in the system is also decided by how much money you're willing to put in that system rather than just.
So right now I run both discretionary and non-discretionary portfolios.
And MI2550 though are the non-discretionary ones. You have a discretionary portion also, where there is no disclosure so far.
They are the non-discretionary ones. I have a discretionary portion also. Yeah. So these two are more or less in balance right now.
Okay, 50-50 sort of, let's say. Okay, and will these two be large chunk of your net worth?
I would still say minority chunk, not majority.
Now that you're financially independent, what keeps you going? What are you passionate about? What makes you come to the work the next day?
So essentially, I think the fact that the market is a changing environment every day, and that it challenges you every day, and the fact that you can be humbled by it at any point of time, it sort of keeps you wanting to discover it more. Every day, at least I can say I learn something new when I come to the market. Something new is getting into my head every day. So that is what keeps you going. And yeah, I mean, I guess it is the learning, it is the the creativity that is available for you to demonstrate in the market. I think that non-mundaneness of the daily routine, because where you start at 9 o'clock and how you reach 4 o'clock is usually I don't really realize where time is gone. Father had a very interesting anecdote on this. So he used to tell me that he follows a VV principle in life, WEWE, and he told me that this is a theory by one Dr. Johnson, and I used to believe him. Incidentally, he was diagnosed with cancer in 2009, and I spent a good four odd years going with him to hospital. I was practically in a hospital every day from 2009 to 2013. So I had sort of given my business to my managers to run, and when I saw the kind of sufferings in the hospitals there 4 years, it kind of totally changed my perspective to life. It totally changed my views on business, money, relationships, and I became so close with my father in those 4 years that I would not have talked to him as much in the previous 40 years. So he told me this principle that he has followed it since his early days, that WEWE was that first W is walk. So you must walk every day, and you must walk till you can't walk more. So 8 to 10 kilometers is what he used to walk and jog every day, even at that age. Then the second letter was E, that you have to keep yourself entertained. So you must be enjoying your life. Try to find ways in which you are working and enjoying your life. It should not become a sore point of your of your day. Your work should not be. Third W was intellectually stimulating work. So do certain work which will keep your brain stimulated. Whether it is generating returns to you or not is a separate issue, but do something creative, do something which will stimulate your brain. And the last E, according to him, was eating, that you must eat to your heart's desire, and the walking part will take care of everything. So he said if he followed WWE for his entire life, and he when he was diagnosed, I mean, he was running 8 kilometers a day. He was like a fit 45-year-old at the age of 68, and but he got unlucky with the disease. But later on, after he passed away, I googled WWE. I said, let me look at who is Dr. Johnson. I couldn't find any, so it was his own creation.
Interesting.
So it was his own creation to influence his children. Maybe if you had said that I have created it, I may not have believed him. But
Expert bias he was creating.
and unconsciously, it created a lot of health focus in our family. So my wife walks a lot. I do it. My mother, those kind of things. So yeah, I don't know where we started this from, but yeah. I hope you and your listeners can take something out of this. I don't know. I told Manish before we started that I don't know why you want to interview me. I'm a simple guy.
I think when we are thinking about the podcast, also we're not really thinking of like an interview sort of, but more like a discussion where people can have more intellectual understanding to take away.
Correct. And when you are explaining certain things, it becomes clearer to you for sure. Yeah, that's true.
Yep. And anyways, you leave that to the audience. I'm pretty sure they have picked up some very nice nuances. Thank you.
Thank you so much.
Okay, thanks a lot.
Thank
Alok.
you.
Thank you.